The stock market is unraveling. If you're watching the stock market today, like I was, you know exactly what I'm talking about. So earlier in the day, the market was doing great. I think at one point, the Qs were up about 1%. The SPY was also doing really, really well. And below the surface, we had a lot of growth stocks and tech stocks that were actually looking really, really attractive. Several of them were up, 6%, 3% on the day. So it was really looking good. And then this afternoon, some real selling pressure came into the market. We had this really nasty reversal. So you can see exactly what I mean here. So we're looking at SPY. This is the S&P 500 ETF. And you can see today that we almost got back to the former all-time highs, the intraday all-time highs. We didn't quite get there. And it turns out it just wasn't meant to be, because when the selling pressure came in, it came in hard, and we just lost all the progress that we made today. And you can see here that after being above that rising 10-day and 21-day moving averages earlier today, we just lost all that. The SPY cut right through those moving averages like butter, closed down on pretty heavy volume, and we printed a bearish engulfing candle. So to me, this shows all the characteristics of a reversal candle. We already had SPY, starting to lose some momentum up here, but sideways consolidation, sideways trading isn't always necessarily a bad thing. It doesn't always resolve itself lower. Sometimes it's just the market's way of taking a breather before beginning its next leg up. But in this case, it just wasn't meant to be. So we got hit really hard, printed the bearish engulfing candle. And the question is, where do we go from here? If I'm just looking at SPY in a vacuum, the first area that I'm watching is this rising 50-day moving average, which is currently trading around 506. We closed the day at 513. So that would be the next major area of support that I'm watching. And whether or not that holds remains to be seen. I actually think we go a little bit lower than the 50-day moving average. And the reason I say that is because of what we're seeing in other areas of the market. So we look over at the Qs. So this tracks the NASDAQ 100. And you can see here that there's even more weakness. So if you were to compare the Qs to the SPY, the thing that really jumps off the chart, in my opinion, is that on this rise up, you started to see momentum wane in the Qs a lot more than you saw in the SPY. And that's because the Qs are heavier on tech, and tech has been underperforming as of late, hasn't been doing well as SPY, which, SPY consists of weightings are a lot more evenly distributed relative to Qs, which is very, very tech heavy. And SPY, as of late, has benefited from strong performances from other areas of the market, particularly energy and materials. So the Qs didn't get that benefit as much. But when we look at the price action of the Qs, not only do we have this, potential rounding top in play, and here we also have a bearish engulfing candle. We've not only sliced below those shorter term moving averages, so that 10 and 21-day moving average, we're now below the rising 50-day moving average. So that's a big reason why I think the SPY could ultimately head below its 50-day moving average, which it hasn't tagged yet, is because you're already seeing the Qs do that. And other areas of the market are also showing signs of weakness that we don't want to ignore or just brush aside. This is very important action that what we're seeing in semiconductors right now. So if you've been following me on Twitter, if you watched some of my prior videos, you know that semiconductors are a bellwether industry group. They really say a lot about risk appetite. They're cyclical in nature. They're technology stocks. So when they're doing well, it generally means we're in a risk-on environment. They also can tell us a lot about the economy, especially the modern global economy. Because these days, semiconductors go into everything. They go into our cell phones, they go into our computers, cars, you name it. So semiconductors are everywhere. And if there's strong demand for semiconductors like there is right now, that generally means that the global economy is doing all right. So the strong performance that we've seen from semiconductors as of late was a really, really bullish sign. And we were just, waiting for semis to make their next move, because they led this initial rally. You can see the big move that they made off the October lows, and they led this rally up here. It was really driven by stocks like Broadcom and NVIDIA. A lot of other semiconductors, smaller semiconductors, also did really, really well. And we had this multi-week consolidation. And I was thinking this could potentially break out to the upside. And I was saying that because of the structure we had here. So you can see we had the sideways consolidation. I thought this was just, a bull flag potentially in the making. And we were able today to get back above the 10-day and 21-day moving average. So to me, that looked really, really good. This was shaping up for a breakout to the upside. We were also seeing, strong moves out of names like Applied Materials. Broadcom was up quite a bit early in the day. Lam Research, a lot of individual semiconductors, TSM were setting up and looking like they could break out to the upside. But as it happened to a lot of stocks in the afternoon, they got hit by the selling pressure, and so those breakout setups failed. And what do we have here? We have another bearish engulfing candle, and below the shorter-term moving average. We're still above the rising 50-week moving average, or 50-day moving average, excuse me. So that would be the next area I would watch for semis. We'll see if we get there. I would think that we get there, and the hope is that this level holds, and that's the extent of selling. We'll have to see how things shape out. I actually think that semis, based on how today's events unfolded, I think we could go lower than that. Part of the reason I say that is because of the action that I've seen out of NVIDIA. So this is obviously the world's biggest semiconductor stock. It's also one of the just most important stocks on the planet by far. After the tremendous run that NVIDIA has had over the past few years, it's become one of the largest stocks on the planet, and really a poster child for the bull market that we currently find ourselves in because of its importance to AI. We look at NVIDIA here, though, after having this massive run up, doing exceptional to start the year. We've had some sideways consolidation, and now we're starting to, looks like to be putting in a topping pattern here. So you can see that this looks actually weaker than the chart that I just showed of SMH, which holds a lot more semiconductors. And the reason I say this one's weaker is because today we were unable to get back above that 10-day moving average and got rejected at the 21-day moving average. And now those shorter term moving averages are starting to curl over and potentially roll over. And if that happens, I think you could definitely expect NVIDIA to fall back down into its rising 50-day moving average. And whether that holds and whether we get a bounce there remains to be seen. But this is a pretty big red flag, not just for semis, but for the broader market. And I thought, this choppy action in here, I didn't necessarily see it as bearish. It was not something I wanted to get involved in because there's a lot cleaner setups in the market, a lot riskier setups to buy. I just thought, maybe NVIDIA was, trying to fake a lot of people out because there's so many eyeballs on this stock. And this is the same for SMCI, another semiconductor name. It seems like most traders and investors have their eyes glued to those two stocks, or a few other stocks, but they're really crowded trades right now, and just trades that have a lot of eyeballs on them tend to have a lot of tricky price action. So I was watching it out of the corner of my eye, but it wasn't something I was looking to trade. But now when I look at it here, to me it looks like a potential red flag for the market. So you're definitely going to want to keep a very close eye on how NVIDIA trades in the coming days. Software was another area of the market that I was starting to get pretty bullish on. In part because I was starting to see some new leaders, or some stocks that were leaders in prior periods, but had consolidated and built out some bases. Those were starting to break out to the upside. So DraftKings was doing really, really well today. HubSpot, you had Spotify doing quite well. Several software stocks that I watched looked like they were breaking out to the upside and really starting to reestablish themselves as leaders. And the leaders normally, almost always, will front run the action of the ETF. So the fact that we were seeing these breakouts and strong action out of individual names, to me, led me to believe that IGV could follow suit. And at one point, we were above. IGV was above its 50-day, 10-day, and 21-day moving average. So I thought, if we close like this, or even close a little bit higher than this would be a really, really nice setup. But we got rejected, as did other areas of the market. Closed near the lows, bearish engulfing candle now, and now we're below those shorter-term moving averages. So I think this likely heads lower now. I think you can, now we can safely say that this is likely just distribution for IGV. And the main area I will be watching, at least initially, is these, December highs here. So we've already tagged this before. It acted as support. We bounced off of it, and that, really ignited another, consolidation up here that, I thought would resolve higher, but wasn't meant to be. So we'll see if this gets tested again. You're really going to want to see that hold, because if it breaks down, then we got to start looking at some lower levels down here. But I'm going to be watching this very closely in the coming days. And yeah, so I mean, it's not looking good in tech right now, despite the progress that we saw from some individual stocks make over the past few days. And the question is, why didn't I see this coming? Why did I have to, close out some of my weaker positions today? And why did I have to put some hedges on when the selling started to come in? And it's because I wasn't seeing too much of a red flag or warning signs out of my favorite macro indicators, which would be the dollar and bond market. So this is the U.S. dollar index chart. So this chart tracks the dollar's performance against a basket of major currencies. It's majority weighted against the euro. So this just gives us a sense of how the dollar is performing relative to other international currencies. And you can see here that the dollar had this massive run up in 2022, and that created a lot of problem for risk assets, including equities and crypto. Neither of them like that. But the dollar has, it peaked in December or September 2022, right around when stocks and crypto bottomed. And then it's just, been in a downtrend. It had this initial, real sharp sell-off, and this was a period where stocks did very, very well. And we've just been trading sideways for the past, several months, really, going all the way back to 2023. We've just been chopping around here. But it looks like we're starting to break the downtrend that we've been in since these former highs. And you could see when we look over on the daily here, we actually broke above that downtrend level, but we couldn't get above these recent highs. So to me, it was potentially looking like we had a false breakout in the dollar. And false breakouts often lead to powerful moves in the opposite direction. So there was a chance that the dollar could roll over here and head lower, and that would be a bullish indicator or bullish development for risk assets. So far, that hasn't happened yet, but we didn't see a ton of strength. We didn't see a strong bounce in the dollar today, which I was, as the selling started to come in today, I kept going over and looking at what the dollar was doing. I didn't see a strong bid for the dollar, so I was a little confused, about what's happening, because you're not seeing this big macro warning sign flash. You're also not seeing it in bonds. So bonds move inversely to interest rates. So you could see during this period here, you could see that bonds were falling, and when bonds were falling during that period, stocks were doing pretty poorly, because or at least rate sensitive stocks were doing poorly. But what we've had happen with TLT as of late is we rallied off the October lows. We had this big rally, and that coincided with a decline in interest rates, and then we had a pullback. And so during this pullback and this potential breakdown here that we almost had, people were thinking, okay, interest rates are going to rip higher again. That's going to create a lot of problems for the stock market. But what happened was we had this breakdown in TLT, but we didn't have the follow through. Yes, it stayed below there for a day or two, but today we saw bonds rally, and TLT got back above this key line in the sand that I've marked here. So when the selling was coming in today, I was looking at TLT, I was looking at the bond market, and you really weren't seeing major red flags out of those macro indicators. Also, the VIX earlier today, was deep red, and that was when the stock market was doing well, and so that seemed perfectly normal to me. It would have been a bigger concern if I were to look at the VIX and see that the VIX was green on a day when stock market was also green, but we didn't have that. So there wasn't really a major warning sign on the VIX in the dollar or bonds. So I thought that was pretty interesting. So part of that, when I think about it in those terms, I think that what we could be having in the market right now is not a big macro event or not a big market top, but maybe the market's just looking for a reason to sell off. The market has had this huge run up as of late, and people will assign all sorts of narratives to what's happening in the stock market right now. But we could just be getting a much needed, much overdue pullback, and that's why you're not necessarily seeing it reflected in bonds or the dollar yet. It could just be a primary equity thing. As far as what areas of the market should you be looking at for potential longs if you're someone who's more inclined to get long the market than short the market? Well, let's look at what's been doing well as of late. So materials, these are really your commodity stocks. They have been doing exceptional as of late. You can see XLB recently broke out to new highs, so it got above its early 2022, late 2021 highs. And, looking really good. You've had some strong names within this sector emerge as leaders, such as Southern Copper and Freeport. That's FCX. But my concern here with XLB is a couple things. So you can see how many green weeks in a row we've had to get to where we're at now. So this really, really strong, powerful move broke out of resistance, without much, fight, to be honest. But, we did expel a lot of energy getting up to this point, and we're quite extended relative to that rising 10-week moving average. And we look over at the daily, you can see that we also printed a bearish engulfing candle on the daily, and momentum was starting to wane a little bit up here. And I don't have the RSI on this chart here, but I'm looking it up on my other monitor right now. And the RSI for XLB actually topped 70 recently, and to me that's a bit of a red flag. The way I think about relative strength, RSI, is that, if you have an individual stock and it hits, high RSI levels and gets really, really overbought, that can be a really bullish sign. That means that there's a lot of institutional demand for that stock typically. There's a lot of demand for that stock, period. And it's showing relative strength to not only the broader market, but the index. But when you see a high RSI reading, a very overbought reading, for a sector ETF or the index, that's usually a red flag. That usually means that that asset, that either that sector or that index, is getting overbought. So I think that's the case here for materials. So I would, basically, I would watch materials. I would wait for setups and maybe some bases sideways action to form before just diving into the market, because I think it does. Needed a breather at this point, despite all the strength that's shown relative to the indexes as of late. The same goes for energy. You can see here we've broken out to multi-year highs out of this consolidation pattern. A lot of green weeks in a row to get here. Broke out of resistance without much pause, so it didn't even take a break. It just rammed through those prior highs without much problem. You can see, it had a little bit of you basically traded sideways for a couple days before ripping through there. But we were red today, as were many areas of the market. Not, it outperformed the indexes, but still red on the day. And this, this candle here, relative to where we're at with this rising 10-day moving average, I think you can make the argument that energy stocks are also extended. And again, I don't have the RSI on this screen, but I'm looking at my other screen. Today, XLE closed with an RSI reading of 83.5. So very, very overbought on the RSI. And so to me, that's a reason to exercise some caution and discipline if you're looking to put on new trades within energy, because I think this sector, along with materials, is likely due for some consolidation or even a pullback. Despite the recent strength that's shown. As far as what about gold? So gold has broken out of this massive cup and handle. I'm sure you've seen people share this pattern on Twitter before, on YouTube. It's quite the impressive long-term pattern. Last month we broke out of it, rallying up nearly 9% on the month. We've had some nice follow through so far this month. But the thing about gold, in my opinion, is you still want to trade it. If you're a trader first, I think you still want to trade it by what you see on the chart. You want to think about it objectively, because there's no reason, there's no guarantee that investors or traders are going to take shelter in GLD or gold because stocks are selling off. We've seen gold perform well during times of turbulence, and we've seen gold do nothing during times of turbulence, and we've seen it also do poorly. So I think the idea that it's a safe haven, it's a hedge from volatility, I think is a bit misguided. If you're looking to protect yourself from a market sell-off, I think you're probably better off shorting stocks, hedging. You could buy an inverse ETF, you could buy some puts. You could also just hold more cash than usual and wait for the dust to settle. So I like gold long term, but I wouldn't be in a rush to put all my chips in the gold because you think a sell-off is coming at the index level for equities. Well, one last thing I want to mention before we get to a few stocks that showed really good relative strength today is I thought it was very, very interesting how Bitcoin performed today. So Bitcoin is actually up about 2.9% on the day. It's still within this consolidation pattern that it's been in since breaking out to all-time highs recently. I just drew this potential bull flag pattern here because that looks like a channel that could potentially be forming, but we'll have to see how this shakes out. But the overall relative strength that we're seeing from Bitcoin here, and the fact that it didn't sell off with equities, is really, really interesting to me. And it also kind of confirms what I'm seeing in the bond market and the dollar. I think if we were really seeing a truly risk-off movement that was something bigger than just a routine sell-off or a pullback for stocks, I think you would see confirmation. You would see Bitcoin getting wrecked right now. You would probably see bonds doing poorly, and you would see the dollar rallying. We're not really seeing any of that yet. And so that leads me to believe that this may just be a run-of-the-mill correction, much needed overdue correction for stocks. But since we're on the topic of Bitcoin, you're probably wondering, what could be next for Bitcoin. I think the best way to think about this is if Bitcoin can close above and hold this mid 65 levels, you want to hold these late 2021 weekly highs. So this is right around 65.8, 65.5, whatever you want to call it, right in there. It doesn't need to be super scientific, but I think you want to be a close above this level here. So I'm going to put it here just so I can get as good a level as I can here. So I'm seeing about 65,650. So yeah, you really just want to close above here, and we're currently above that level. And you can see that the times we have dipped down below that level after rallying up this much, those dips have been bought. So that to me is really encouraging. If Bitcoin does lose this mid 65 level, the next level I would be watching most likely would be these former monthly highs up here. You could see that this level was tested a couple times back here, and most recently right here, and that is about 65,650. So 65,650 is the level that I am watching. It has a lot of confluence and importance from both a weekly and monthly time frame. So Bitcoin definitely an asset to keep an eye on, because if we can hold this level and we don't see crazy moves in bonds or the dollar, then I think the next level you're going to want to watch for Bitcoin would be probably 100,000. I think that $100,000 level, out of this massive base that we formed here, out of flipping these former highs, would be reasonable. And there's some psychological importance to big round numbers like 100,000. So that's it for Bitcoin. As far as stocks to watch in the coming days, ultimately, I think you're going to want to exercise, some patience with, if you're looking to put new money to work, because by the looks of it, it looked like the selling that we're seeing at the index level could, play out over several days or longer. If we do get a 7% correction, 5% correction, whatever. It probably won't happen over the course of just 1 or 2 days. It could take a few days, and there should be chopping around. But I think it's never too early to keep your eyes on stocks that could emerge as leaders for the next leg up. And one name I'm watching very, very closely here is DraftKings. I've shared this chart a ton on my Twitter before, and I just really, really love how clean this name trades and how it's setting up on both the daily and weekly. So today, DraftKings was up a ton. It was rallying really strong. It was one of the strongest stocks in the entire market. And despite the sell-off that we had today, it still closed up 1.4%. So some nice relative strength from DraftKings today. And you can see here, it just after climbing out of this big base that it built, it's just been grinding higher and flipping level after level. And you can see here that we came back down and tested this rising 10-week moving average. We bounced off that. So overall, the trend is very, very strong today in DraftKings still, and it showed good relative strength today. So definitely a name to keep an eye on. Really like what I'm seeing from HubSpot. You can see it had this cup and handle pattern here. I didn't draw the lines here. I should have them on here. I have them on my stock charts, but I don't have them in trading view. But you can see the big rounded base here, the second base here, and then we've had this multi-week consolidation. And today we started to break out of that on heavy volume. And this was almost up about 10% at one point today, over 9%. It closed the day up about 5%, but the volume that came into HubSpot today, I didn't see if there was news, but the volume that came into this name today was really, really impressive. And you can see that it closed at the highest level since dating all the way back to, what is this, about January of 2022. So super, super bullish move from HubSpot today. It does have the fact that software stocks are potentially going out of favor, working against it because it is a software stock, but the relative strength on this name is really off the charts here. So HubSpot, definitely a name to keep a close eye on. Spotify, another software name that's looking really, really good. This stock broke out of a mini consolidation yesterday after reporting that it's going to raise its prices, and the stickiness of Spotify's offering allows it to raise prices. It's like Netflix in that sense. I think they raised it like a dollar or two per month, and I don't think anyone's going to cancel their Spotify subscription over that. So it had a strong move, broke out on heavy volume. We had big buying volume pour into this the back-to-back days, and was able to close green today. And yeah, this one looks really, really good. I'm not sure how much momentum, traction it will have if the market completely falls apart. But if it's just a kind of an orderly sell-off in the coming days, I think Spotify would be a name to keep a super close eye on. And NTNX is the last name, another name that I've shared on my Twitter before, and it has broken out of this massive base here. You can see this base goes all the way back to 2018, broke out of it on the monthly level. We broke out actually in February. We have spent March consolidating, and we're starting to wake up again here in April. The rising 10-week moving average has caught up with it. We've held that on pullbacks a couple times here, a couple weeks in a row. It tested that, and today it was up about 4% at one point today. Didn't have as strong a close as some of the other names, but it did still manage to close up 0.9% on the day. So overall, this one's looking really, really good. You can see it just broke out of this, basing pattern here. So NTNX is looking super solid. So those would be the names that I would keep a very close eye on in the coming days. And you will also want to, just keep an eye out for what stocks are bucking the trend if the indexes and, select sector ETFs start to fall apart, because those are going to be the names that have the least damage done to their charts, and they will be ready to emerge as leaders once things settle down. So that's it for today. Hope you guys enjoyed this video, and I will talk to you soon.